The first stock that I'm buying in March of 2025 is one that we talked about last week, Celsius. Celsius reported earnings last week. The market loved it, but the main reason why the market was so happy was because they announced of an acquisition, their main competitor, Alani Nu. The stock gained over 30% in one single day, but after that, the stock price has been falling. And today, I believe Celsius is undervalued, there is a margin of safety, and we may increase our position in this company. Let's first understand this acquisition, how important it is for Celsius, whether this is going to create shareholder value or not. I believe it is. I talked about it in the last video. I believe that the probability that shareholders lose value from this acquisition is very low because there are many things you have to consider. Celsius is a pretty young company. It has been around for decades, but its recent growth has only been in the recent past years. And it is still growing. They have partnered with Pepsi. They are growing at a fast rate. There has been a slowdown. There's competition. And that's why they are acquiring their main competitor. But with all the cash that the company is generating, because they are really good at generating cash, what can they do with this cash? They have the possibility of paying dividends or buying back shares. But I don't think these are the right choice right now. It's better to try competing with the smaller competitors and even with a bigger Monster and Red Bull to become a bigger player in the US and internationally, because the international expansion has only just started. And by acquiring the main competitor, Alani Nu, this is a better capital allocation than just buying back shares or paying a dividend. Of course, pricing is important, and at $1.8 billion US, it's 1.65 if you consider the tax benefit they're getting from it. I believe it is the right price to pay. They did not overpay for Alani Nu. Considering that now the competition will be less, they will be spending less money on marketing to try to outcompete their competitor. They can focus on growth, and Alani too is profiting from the leverage of Pepsi. But most of the value of Celsius today is in its growth. That's why even though the earning multiples of above 30, for some people that may look expensive, but the potential for Celsius is in its growth. Even though at 30 times earnings, I believe it is undervalued. That doesn't mean that we need to buy at any price. We need to take a big margin of safety, because when the value is in the growth, there's more uncertainty in growth. When you know that the current business is generating such amount of cash flows a year, and then you believe that maybe in the next 5 years it's going to be bigger than that, you need to take a bigger margin of safety because there are uncertainty in growth. And I did that with Celsius, and I still believe it is undervalued. Of course, I would prefer to get at a cheaper price, and I'm waiting for the price to fall further to buy more of the shares of Celsius. The second stock I'm buying in March of 2025 is one that is growing at a fast rate, but even if we don't consider the growth, then it is undervalued. That's the kind of investments I like. And it is a little different from what I usually talk in this channel. It's a regional bank, Northeast Bank. I first started buying the shares in September of last year, and I did not really get the opportunity to buy enough shares, and the stock price just skyrocketed, I believe 50% in just a few months. But now the stock price has been falling a little, and even after great earnings last quarter, the stock price has been falling. And if this continues, it will go at a range that I can buy more shares. So why I'm not rushing to buy shares of this company, and even Celsius, and even the third one we'll talk about in a few minutes, because you have to do comparisons. It's not because a company is undervalued by, let's say, 25% that you need to rush and buy. If you can find another one undervalued by 40%, you would rather buy the other one. Of course, you have to look at quality too, because it's better, in my opinion, to own a very good company undervalued by 25% compared to owning a poor company undervalued by 50%. So you have to make these comparisons. How much money you're risking and what is the potential reward. With every investment you're making, you're risking some of your money. There is always a possibility that it goes to zero. So how much are you actually risking? And how much are you willing to make from that investment? So you look at the risk and reward. With Northeast Bank, the risk is here. It's a bank. Banks are risky. Many people say banks are not risky. They're easy investments. I disagree. They are risky because only one small mistake can destroy a lot of equity for shareholders. In the case of Northeast Bank, they are unique in the way they operate. Other regional banks usually have branches where their clients coming and putting their deposits and taking loans. This is not the business that Northeast Bank deals with. They have their clients in Maine, and these clients are usually rich clients. They are going to deposit a lot of money, expecting not to be paid immediately. So the deposits are long term. In other words, the bank can borrow money from these people and repay them at quite some time in the future. This brings a lot of benefit to the bank. They have this cash for quite some time that they can use and do other things, make other investments. For a normal bank, they are going to loan the money to their depositors themselves. So they loan in the region that they are operating. But the loan business of Northeast Bank is beyond the borders of Maine. It goes all around the country. And they do that through the origination and also the purchase of loans. It depends on the situation. If they think that it's better to originate the loans, it's mostly commercial real estate. If they think that it's better to originate, they're going to originate. If they think it is better to, that in the market itself, there are loans that are undervalued, they are going to purchase this loan, they are going to purchase. And if you look at the spread, how much their earnings on interest and how much they are paying in interest is one of the largest in the US. It is a sort of Berkshire Hathaway, but as a bank. But instead of buying companies, they are buying loans. Sometimes they originate their loans. And as I told you, it depends on the situation. And there are situations when they are going to take the cash and buy back shares instead of trying to find loans, because they focus on the high quality loan. That's why the delinquency rate is very low. By focusing on high quality, the delinquency rate is low and the default rate is also low. They are able to achieve returns on assets of around 2%, which is pretty high for a bank. I believe that Northeast Bank can grow. They can grow their loan portfolio, but I don't count all of this when calculating the intrinsic value. For me, I don't consider the growth because we don't know what's going to happen in the future. So I prefer to take this growth as a margin of safety. And that's why today, based on the analysis of Northeast Bank, which by the way you can find on the Superinvestors Club, on the Superinvestors Club, you can have all my analysis, all my research, and even an investing course for beginners. There's another investing course I'm working on. It's a little more advanced, but almost everything you can find on the Superinvestors Club. And it also helps this channel, of course. I don't make much money on YouTube, so if you want to contribute to this channel, please join the Superinvestors Club. You can have a free trial if you don't want to pay also. And the third stock I'm buying in March of 2025 is a Swedish company, Evolution Gaming, Evolution AP. We talked about it before, and I say that the market had very high expectations on that company. Earnings, revenues were growing at a fast rate, and the market was just pricing the stock for perfection. But lately, there has been a reduction in growth. It's normal because of regulations, because there were strikes in Georgia where they have one of their main operations. That's why revenue growth has decelerated. But the stock price fell. It fell more than it should have. And the company is generating a lot of cash, using all the cash to pay dividends. They have a high dividend yield. And most importantly, buying back shares. So when things recover, you're going to own a higher percentage of the company than before, just because you're holding while others are selling their shares. So what exactly is the business of Evolution Gaming? They are not a gambling operator. They don't operate online casinos. So let's say you have your favorite online casino where you go and play, and you have these live performers there, different games you're playing, so you have a real person in front of you. This person is not employed by the casino. They are employed by Evolution. But then the operator, the casino operator, is going to pay Evolution to have these services. So the risk on regulations is lower with Evolution because usually the regulators will go after the operators, which is not the business of Evolution. But if one operator is affected, and let's say they cannot operate anymore, of course, Evolution also is indirectly affected. I said before that I'm not buying much of Evolution because I already own another operator, the national lottery operator in France, La Française des Jeux, FDJ, which is my third largest position. But today, when I look at Evolution, the stock price is dropping more. There is a big enough margin of safety that it's good to own both companies. Of course, I understand the risk of being so concentrated in such an industry. I will recommend you watch the video about Evolution where I talk about all of this. Have a nice day and goodbye.